Hello, ladies and gentlemen. Welcome to Triple N Media. I am NIK NIKAM. In this presentation, we are going to look at Fibonacci numbers as it applies to stock price retracement and impulse waves. Fibonacci numbers are exceedingly important in terms of determining where a correction would probably end or how long wave 3 or wave 5 can extend compared to the previous wave. Most money managers and hedge fund managers very closely follow these Fibonacci numbers. So as a retail investor, if we follow their footsteps, we should be in line with the big minds. So let's join the big minds. Fibonacci numbers are a series of numbers based on a mathematical relationship. What does that mean? If you take, for example, a shell, the way it is carved is based on a very fixed mathematical relationship. I mean, we are talking about nature. How is it that every shell that is created by nature has precise calculations built into its structure? And we're going to use those nature's lessons in real-time stocks trading. The curvature of a shell is based on the concept that the first curve is like 1, then we have another 1 here, 1 plus 1 will be 2, 2 plus 1, and this will be the 3, and 3 plus 2, this will be 5, and 3 plus 5 will be 8. And that's how the curvature of a shell is formed. And let's look at, here's an example of a curve. And when you go from the innermost circle, this is the starting one, maybe 1 and 1. Then this could be 3. And as you come to outside, 5 and 8 and 13 and so on. So based on this, we get numbers. 0 plus 1 is equal to 1. 1 plus 1 is equal to 2. 2 plus 1 is 3. 3 plus 2 is 5. 5 plus 3 is 8. 8 plus 5 is 13. And the numbers go on. What has this got to do with stock market? And stock market prices are in terms of dollars and cents. Yes, doesn't make any sense, does it? Oh, yes, it does. Just bear with me. And another relationship between the Fibonacci numbers is their fraction. For example, let's go back here. If we divide 8 by 13, we get 61.2%. If we divide 1 by 2, we get 50%. So there is a fixed fractional relationship between these numbers. And that's where the Fibonacci retracement comes into significance when we are talking about impulsive waves followed by corrective waves. So if we say the impulsive wave moved by 13 points and the correction was down 8 points, that means the correction was 61.2%. And these numbers are important because the big money managers follow these numbers very closely when they are following the movement of the stock prices over time. And as you can see, the fractions of all these run pretty close to 61.9, 61.5, 61.2, and the last one I said. But the numbers we really want to focus on are 23.6%, 38.2%, 50.0%, 61.8%, 76.8%, 81.6%, and also 161.2%. I said, how in the hell did we get 161.2% when we are talking about fractions? Well, let's say, for example, we have a movement of $5 on wave 1. Then we have a retracement. Now we want to see how high the wave 3 goes. As you know, wave 3 is the most impulsive wave, and we want to see how far it goes. And if it just keeps going up and up and up and up and up and up and like this, then you get really worried. I said, oh man, when is this going to, what if it crashes like this? So you use the Fibonacci extensions. Okay, if it covers 100% of the height of the wave 1, that is 100%. And when you get to 161.2%, you put a sort of a mental stop. I said, maybe I need to take my profits and get out. And occasionally, when the bull market is in full charge and the bears are just all fallen to the ground, this can go up to 261.2%. But when the time you get to that point, you really need to be out of the market or just closely follow other trend lines and oscillators to see when you want to get out of the market, or at least put a stop loss. And that's why all these things help us to maximize our profits and minimizing the loss and risks. So Fibonacci numbers must be engraved in our system if we want to be investing in the stock market in real time, be it short term, intermediate term, or long term. And I talked about this 100%. 100% is not part of the Fibonacci system, but we do use 100% and 200% because they are outside, but they are relevant, and I'll show you an example. 161%, 261% it should be. Talked about those. There are a few other things I want to mention before I get into the real-time chart. Fibonacci Arcs. They kind of fan off like this, and they give the support and resistance levels. Similarly, Fibonacci fans is another way of displaying these Fibonacci numbers, which will help to display the support and resistance levels. Fibonacci time zones. Time zones are extremely important. Most people don't understand or don't apply the time zones, because when it takes like 12 hours for an impulse wave to form, like 1, 2, 3, 4, 5. If it takes 12 hours for the impulse to form, the correction cannot be done in 4 hours or 6 hours. If you think the correction finished at 4 or 6 hours, that is incorrect. You just have the part of a correction. Usually a correction should be equal to or greater than the impulse wave. If your wave 1 is 4 hours, then your correction should be 4 hours or greater. So let's keep that in mind. The example I'm going to show you will demonstrate that. Now let's look at a real example and see how we can use these numbers in a meaningful manner. Here is a NASDAQ triple Q chart. As we know, the market bottomed on March 5th. Then we had an impulsive wave going from here all the way to the top here. And then on Friday, we had a correction. All right. So here is our impulse wave going from 0 to 100%. Now the question is, how much is this retracement supposed to be? The retracement, as we can see from the top, is 38.28%. So that's pretty good. I mean, if it's retraced 38%, it is acceptable if there is an extreme bullish sentiment in the market. 38% for a wave 1 is not the usual correction we expect. We expect it to be like 50% or 61.2%. So here, what does it tell us? Here, another thing based on the Elliott waves, all corrections are A, B, C. That's a zigzag correction, or A, B, C. So depending upon the market sentiment, either we can have a flat correction or we can have a zigzag correction. If this happens to be a zigzag correction, this is just part of the correction we have seen last Friday, and the next part, the C wave, which is the most impulsive wave, could bring this down to 50% or even 61%. So that's how we look at these numbers and say, if you want to get into the market, one place you can probably get into the market would be like 306, 308, somewhere around $307. Okay, we have a C wave which ends at 61%. So you can put a buy order, 1,000 shares of QQQ, limit 306. Then you could be in for a good entry point. But it can trace as much as 81%. Usually the first wave in a new trend can be traced up to 60 or 80%. That's one thing we need to be aware of. And if it were to trace 81% and then goes back, then we just have to wait. So if this is a correction, either we can start here as a flat and then come down and maybe retrace up to 50%, or it can be a zigzag correction going to 61.86%. This can be applied to any time frame, and it can be applied to any wave. You can just do it for wave 1, or you can just do it for wave 1, or you can do it for wave 3. We want to see what percentage of the wave 3 has been retraced by the market. And when all the 5 waves of the Elliott wave are completed, then we include all the 5 waves, like from here, from the beginning of a new trend to the top of the trend, and see how far the retracement is. We not only retrace the price, but also the time interval needs to be looked into. So keep these two things in mind. This will help us a great deal, along with other indicators like stochastic, RSI, and Bollinger Bands. They all help us to be having a technical approach to market entry and exit points. Thank you so much for your time. Please do subscribe to our channel, and we'll see you next time.